Hello, good morning and happy Friday. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term technical outlook that I tend to actually highlight for today on a very short-term basis on the broad-based cross asset classes ranging from the major FX pairs, the benchmark US stock indices, as well as the rest of the world indices from Asia Pacific to Europe. And lastly will be the West Texas oil, WTI, and spot gold XAU/USD. Let's have a recap of what has taken shape yesterday in terms of the performance of the cross asset classes and as well as in relation with the key events or data that has been released in conjunction. So yesterday we do have a rather, I would say, moderate risk on behavior in the major US stock indices. So if you look at the major US stock indices, as I want to highlight for you guys to take a look over here, is that all the four major US indices closed in the green yesterday, for sure led by the Nasdaq 100, 1.56%, then followed by the S&P up almost 1%, the Russell 2000 not far behind, positive 0.8%, followed by the Dow Jones Industrial Average, kind of a bit of lackluster, only adding in 0.3%. So the rationale of why the stock market actually continue to be rather firm on the bullish side of the story is due to the persistent or ongoing softness of the US 10-year Treasury yield. So if you look at the US 10-year Treasury yield, let me highlight to you for guys to see. So I've been mentioning this intermarket relation since the start of, in almost every of my daily dose of market insight, and since the start of last week, there's a key level to watch. In fact, two key levels to watch will be the 4.33%, which is the lower limit of the major resistance zone, where the price action of the US 10-year Treasury has refused to break above it and starts to slowly inch downwards since 2 weeks. 1.5 weeks ago, pardon me. And at the start of this week, it managed to actually gain traction more towards the downside rather than the upside by breaking below the 200-day moving average. And 2 days ago, it managed to break below a key near-term support at 4.14%, which I highlighted to you. So what it means over here is that in terms from a intermarket perspective, a lower 10-year US Treasury yield implies lower cost of funding globally because the US 10-year Treasury yield is being used as a global benchmark for longer-term interest rates. And given the fact that we do have lower cost of funding, it will actually translate to a higher, we call it net present value for those who knows about cash flow discounting and in terms of cash flow discounting or any form of discounting that you tend to actually discount back future net cash inflow of corporation back to now at the present. So that also translates to a higher intrinsic value for equity, public equity as per se. So that's also actually explained to us why equity prices continue to remain firm in terms from a global benchmark stock indices perspective. The one that is only kind of lackluster trading neither here nor there is China related proxy, the Hong Kong's Hang Seng indices, as well as the China A shares, due to the fact that we still have a high risk of deflationary risk spiral that is inherent in the China economy. And also do not forget, China and US is still engaging in this hostility between high-tech sector, and especially with the ex-US President Donald Trump being for sure the front runner in this time round to actually represent the Republican camp, and perhaps very likely there could be a chance that he may be the next president, and he may bring back his we call it pronounced US trade tariffs against China products or services. So that actually explains why the Hang Seng index going to underperform versus the rest of the world. So, but nevertheless, in general, with this softness in this US 10-year Treasury yield breaking below 4.14%, it also translates to a weaker dollar that came within our expectation, and as well as also the gold price, spot gold XAU/USD. Bear in mind that gold itself is a zero fixed income asset, means it does not give any dividend or fixed income coupon like corporate bonds or even stocks. The lower US 10-year Treasury yield translate to a lower opportunity cost for holding gold. So that actually explain why gold price continue to actually rally pretty strongly since the start of this week, also in line with the softness of the US 10-year Treasury yield. So hopefully I put everything in intermarket perspective for you guys to have a better understanding on how the interlinkage between these broad-based cross asset classes works hand in hand to one another. All right, so some key data or events that has taken shape yesterday is ECB. So ECB, within expectation, they didn't actually cut interest rates. They still maintain the interest rates, following the same, I would say that the guidance that the US Federal Reserve has given as well in terms of the Fed speak. So let me expand my screen so that you guys could see clearer. Okay, so what they did over here is that yes, they held rates as expected, but what throw off guard market slightly is that yesterday they came up with new projection in terms of the economic metrics like growth and inflationary trend for the Eurozone. So they actually expect a weaker inflation going forward. So that actually increases the prospect of cuts in the summer months of this year. So what we could see, this is the new projection. Let me go all the way down to my screen. Yeah, over here. So I could see the one that is highlighted in black horizontal bar is the December forecast, and the one in bright pink is the March forecast that was released yesterday. So if you look at across the board for 2024, 2025, 2026, inflationary forecast has been reduced much lower. So for the entire year of 2024, ECB officials is expecting it to dip down lower on an annualized basis to 2.3% from 2.7%, and slowly inch downwards, heading to their 2% target in 2025. So that's headline inflation. So if you're excluding food and energy prices, it's a bit much more sticky on the upside. So only coming close to target in that 2% target only in 2026. But nonetheless, if you look at the trend of forecast in terms of the inflationary, we call it trend, excluding food and energy, is still inching towards on the downside. So that actually indicates to us that globally, major central bankers are actually in the process of normalizing their previous cycle of interest rate hike. So very low odds of another chance of interest rate hike. The next step is only the interest rate cut. So the one that is not certain over here is after the first cut, how will be the rhythm of this interest rate cut going forward. So for the Fed officials, some of them has really mentioned that it will not be every meeting. That means there could be a chance that the Fed cut for the first time in the month of June, then thereafter they decide to pause for a while before deciding their next steps. Okay, so this is from the majority of the global central bankers guidance towards us, to market participants. One thing that is standing against the outlier is BOJ. So you all know that Bank of Japan is the only outlier that has short-term negative interest rates, and they are in a mode of still having this ultra dovish monetary policy stance, despite 1.5 years ago where the rest of the global central bankers are hiking rates, they decide to stand pat. The only thing changes for BOJ side of the story is they make the 10-year JGB yield higher and higher for the upper limit, and the last meeting they decided to remove the 1% hard cap of the JGB 10-year treasury yield, so laying the ground roots for them to actually normalize their ultra accommodative monetary policy. That means negative zero interest rates. So what you see over here is that BOJ in the last yesterday, there was actually signs right now. Okay, let me share with you another news. Okay, so right now there's actually an increasing we call it odds slightly, saying that BOJ may actually starts to normalize their short-term negative interest rate. That means, i.e., hiking interest rate back to at most back to 0%. In this upcoming, we call it 19th of March BOJ monetary policy decision outcome. So because in yesterday, there's one BOJ official actually favored an early rate move, and also based on this preliminary findings over here, it seems that, okay, where's the member? Okay, there's one guy who say, yeah, this is the guy. Okay, BOA are getting more confident over the strength of wage growth. All right, so that means they are actually anticipating that the first preliminary finding that's going to be released on the 15th of March this month between the largest Japanese unions in terms of their wage growth negotiation with large corporations for Japanese employers for the financial year of 2024/2025. So there's actually, we call it some findings on the ground that this coming financial year, there will be very high chance of much further increase in wage growth. So that actually gives certain BOJ officers getting much more confident over the strength of the growth. And the one of the member that actually voiced out quite vocally is this guy called Nagakawa. Yesterday he did mention on that. Okay, so with this trajectory of this, we call it talks in among BOJ officials getting much more confident in terms of the Japanese economy from having to actually exit from 20-year plus of deflationary spiral, and also given the fact that wage growth high chance of further increase this year could actually solidify or cement this ongoing we call it inflation trend in Japan to actually remains above the 2% level for a more foreseeable period of time. So this gives the BOJ official confidence, and it's been expressed in the market. So if you look at the JGB market right now, this is the chart I'm going to share with you all for you guys to see. Yeah, so this is a JGB chart over here. So firstly, this is the key policy 10-year JGB yield that is being controlled by the Bank of Japan. So we know that previously, before 28th of July 2023 meeting, so this is the key meeting, this was the prior limit at 0.5%. Then they removed this upper limit and allow it to fluctuate higher to 0.75. Then thereafter, it shift up to 1%, and that 1% limit right now is no longer a hard cap upper limit. That means IE is being now used as a reference level. So what does it mean over here is that being a reference level, it means that the BOJ need not intervene when the 10-year JGB yield hit the 1%. That means they did not come into the market and sell JGB bonds to push down the yield again. And they will also mention that it all depends on the current market dynamic situation at that point in time and the current state of the fundamentals of the Japanese economy for them to actually decide whether they should defend that 1% level that is being the new reference level that's being set by BOJ. So all in all, right, this is actually laying the groundworks for monetary policy normalization and in Japan. And if you look at the rest of the 2-year JGB yield, so this one is not being controlled by the BOJ, it's allowed to free by market forces. So since January this year, which is still in slightly negative territory of negative 0.01%, it's right now has been risen by significantly by 20 we call it a 20 basis point all the way up to 0.2% in terms of the 2-year JGB. So the market right now is actually factoring imminent BOJ normalization of short-term negative interest rate back to at least a zero territory or slightly positive at 0.1% based on the 2-year JGB yield. So that is what markets is expecting, and based on this market expectation, yes, we got to actually see yen strength coming back into the picture. Okay, so finally the yen strength actually came back mid of this week, mid our expectation, where the dollar yen actually plummeted below the 148.40 support level, and that also being supported by the 10-year US Treasury yield spread between the US and the JGB yield, both from a 10-year perspective and more significantly on a 2-year time horizon. That means, i.e., the yield premium of US Treasury over the JGB yield is getting lesser and getting thinner, or I would say in market terms, it starts to shrink down. So making we call it holding US dollar over Japanese yen is not so attractive at this juncture based on what the market is actually implying right now. All right, so this is the key events in terms of the news and data in relationship with market movement that has taken shape yesterday. All right, so now the key thing over here is that before we jump straight into the short-term technical outlook, right? So there's only a couple of key data points to look out for today, given the fact that today is Friday. So right now, for Friday today, what we have the data to look out for later part during the European session at the start will be, okay, this was nothing, this is the final rate, Eurozone final, it's a third estimate, Eurozone economic growth rate. So that is the third estimate already, so that shouldn't be a big surprise at 6 p.m. Singapore time. And thereafter, we do have Canada's unemployment change or labor data for the month of February, releasing at 9:30 p.m. Singapore time. And most importantly, similar time, 9:30 p.m. will be the US state of the labor market. They call it the famous non-farm payroll data. So market participants will be focusing on this as well as the unemployment rate. So unemployment rate pretty much steady at 3.7%, 3.7%, no change. But what's surprising in the non-farm payroll data is after a very strong increase of the number of jobs added in the month of January at 353K added, market now has toned down to 200K added. So given the fact that a very low expectation by market consensus of 200K, any bit of the non-farm payroll data that may come in later at around 300K or above, that could actually give a bit of mean reversion, potentially mean reversion rebound in terms of the US dollar perspective pair. That means, i.e., you know that at the start of this week, we tend to see the dollar sell off pretty steeply, especially against the dollar yen. So any print that is higher than the consensus coming in around 200K and above, that could actually lead to a kind of a spike up in dollar strength. We call it kind of a mean reversion snapback rally after this week of steep dollar sell-off. So I think that is pretty nature in terms of how market sentiment behaves in the short term. But does it change the movement of the dollar strength to actually start to see dollar strength, big bullish reversal from a medium-term perspective? We cannot say for sure for now, because in terms of the price action, the US 10-year Treasury yield still continue to remain weak. Still didn't it broke below the 200-day moving average unless it can actually recapture the 4.14%, then we could start to see a bit more of a dollar strength, substantial dollar strength movement coming back into the market. Okay, so that is the key economic data that to look out for today, the data to look out for today. So now with that, let us now lastly jump straight into the short-term technical outlook. So let's start with the FX market first. So for sure, the FX market, like I mentioned earlier on at the start of my presentation today, we see broad-based dollar strength sell-off across the board. So this is the 5-day rolling performance of the US dollar against other major currency. So using dollar as the base currency, that means $1 equals to how many Aussie, $1 equals to how many euro, $1 equals how many sterling. So we look at for sure a very clear dollars sell off in the last rolling 5-day. So with that, right, where does it goes from now in terms of after this steep dollar sell off from a short-term perspective? So with that, right, before that, let me expand my screen so that you guys could see much clearer. All right, so now let us start with the European currency first. So for the European currency over here, So let me start with this. Okay, euro dollar. So euro dollar, right? Since last week, we maintained that bullish bias, and with the respective resistance level that we keep highlighting or keep updating as the daily dose goes by. So what we could see at this point in time, the euro dollar yesterday, we still maintain that bullish bias with a resistance level at 1.0935, 1.0950, Fibo extension level, and as well as the graphical cluster level over here. So price action now has already hit a overbought level, and upon hitting the overbought level, there's actually a divergence, a bearish divergence that's being flashed out. Okay, higher high in price action, lower high in the RSI. So what it means that after yesterday's push up, there could be a higher chance of a we call it mean reversion, short-term minor decline taking shape into the euro dollar. So bear in mind, all the short-term technical outlook that I highlighted in my daily dose of markets are very short-term in nature, not on a multi-week basis, but more of between a time frame of 1 to 2 days. I would say that because I'm using the hourly time frame to actually decipher the trend movement of the euro dollar. So based on this 1 hour time frame, we may start to see a bit of what I call a minor corrective pullback taking shape because after of yesterday's steep movement, and this steep movement lead to a bearish divergence on the euro dollar. So with that, taking that into perspective, we will be flipping to a short-term bearish bias for today on the euro dollar. But bear in mind, the short-term uptrend hasn't changed yet. Why? Because price action already pierced above the 20-day moving average, the 50-day moving average, and 20-day moving average. So what I'm actually looking at right now is that we know that price action oscillate, they don't go vertical up and vertical down. So now there could be a chance of a mean, like I want to stress again, mean reversion, minor mean reversion, setback or decline within its short-term uptrend that is still intact. So hopefully I make myself pretty clear in terms of the trend, the short-term movement of the euro dollar. So that's the best explanation I could give. 1.097 short-term pivotal resistance. As long as this level didn't pierce to the upside, we will flip to a short-term bearish bias. Near-term support level to watch for sure will be the previous range breakout of 1.0890, 1.0870. That also confluence with the 50-day moving average acting as a support. Only an hourly close above 1.0970 will invalidate this short-term bearish bias to see the continuation of its bullish impulsive movement to expose the next near-term resistance at the 110 figure level. Very similar movement on the sterling dollar as well, which is the cable. So also hitting the short-term resistance that we have yesterday at 12820, the upper limit of this minor ascending channel that I drew from the low of 1st of March. And with that, the RSI also hit a extreme overbought level, but it does not shape a bearish divergence. So given that it hit the extreme overbought level and is now at the top of this ascending channel, and as well as the Fibo extension cluster level of 1.2820, which is confirms the minor swing high of 28th of December. So I'll be using 128.40 as my short-term pivotal resistance level. Flip to a short-term bearish bias on the sterling dollar, potentially there could be a chance of a minor corrective pullback within its short-term uptrend that is still intact because it's trading above the 20 and the 50-day moving average. Near-term support level to watch for that potential minor mean reversion pullback or mean corrective decline, we call it, will be at 127.60, 127.30 for today. So that also confluence with the lower boundary of this upper ascending channel, lower boundary of this minor ascending channel, and as well as I do the Fibo retracement of this current impulsive up move, it will be the 38.2%. All right. However, an hourly close above 28.40 will invalidate this short-term bearish movement to start to see the continuation of this impulsive up move heading towards the next, potentially exposing the next near-term resistance, which is another Fibo extension cluster level, the 1.618 at 128.80, 128.95 level. Okay. So with that, let us take a look at the Asia Pacific currency, the dollar yen. So dollar yen, yesterday we still maintain that bearish outlook on the dollar yen, and it actually hit the hit the support level at 147.90/147.70, and upon hitting this support level, we will close. Okay, give me a minute. I think it's stuck here. We have a bullish divergence that's being seen on the hourly RSI, indicating to us that yesterday's steep down move is losing initial or losing momentum, and that actually increases the chance of a potential minor snapback mean reversion rebound within its short-term downtrend right now that is could be evolving. Why? Because price action has already broken down below the 20-day moving average, and right now it's just whipsawing around the 50-day moving average. All right, so with that, I will have a slightly lower short-term pivotal support at 147.10, which is this congestion area over here from the 2nd of February 2024, this upper limit of the congestion area. So if this ongoing potential slide didn't surpass below 147.10, that could be a chance that the dollar yen could do a mean reversion rebound within its short-term downtrend phase. So mean reversion rebound resistance level to watch will be at 148.70, followed by 149.10, which is also confluence with the 38% Fibo retracement and the 50% Fibo retracement of this ongoing minor downlick that has taken shape from the high of 1st of March to today's Asia session current low. Okay, this level here. Okay, and also confluence with the former minor swing low and minor swing high area in the past of 6th of February and 12th of February. So with that, we'll be flipping to a short-term bullish bias on the dollar yen for that potential mean reversion rebound to take shape within its short-term downtrend phase. However, an hourly close below 147.10 will invalidate this potential mean reversion rebound scenario to see the continuation of that ongoing impulsive down move to expose the 200-day moving average acting as a support as well at 146.20, pardon me, 146.20. That also confluence with the swing low of 1st and 2nd of February 2024. So that lastly, before we go, is the Aussie dollar. So Aussie dollar yesterday we were neutral. Okay, then after breaking above the neutrality, okay, give me, I think my screen is kind of freeze today. Okay, okay, 1 second. It's a bit okay, Aussie dollar. So after kind of 60, we were actually neutral between 65.80 and 64.30. So after breaking above 65.80, in line with the rest of the other major FX pairs, the dollar strength also dissipated in the Aussie dollar. That means we're talking about Aussie dollar spiking above the Aussie spiking above the dollar. This is how it's being quoted, right? One Aussie versus the US dollar. We start to see it hitting the 66.20 level, okay, which is the former minor range swing high of 24th of February to 1st of February, 24th of January to 1st of February. So with that, right, it's now coming very close to the 50% Fibo retracement of that previous medium-term down move from 28th of December all the way down to 14th of February low this year, and also confluence with the former minor swing low of 5th of Jan and 12th of Jan at 65.60. So with that, potentially there could be some signs of a minor pullback after yesterday's steep movement of the Aussie dollar. So what we could see here is that the Aussie dollar could potentially now start to transverse or evolve into a short-term uptrend phase. Why? Because it starts to break above the 20-day moving average and the 50-day moving average, and as well as reintegration back above the 200-day moving average. But given the very steep up move that we see so far today, and in terms of elliott wave, it starts to form a 5-wave movement, 1, 2, 3, 4, 5. And also if you do the 5th wave, potential 5th wave target, taking from the start of the wave 1, okay, 1 second, taking from the start of the wave 1 to the end of this minor wave 3, project it to the wave 4. Okay, yesterday price action was around the 6.618 Fibo extension level. Then you have the 6640 at the 76.4 Fibo extension level. So you'll be using, we also call the 6640 Fibo extension level, target level, 5th wave target level, also correspond to the 50% Fibo retracement that I drew earlier on from the previous down move of December last year to 14th of February this year, and also graphically the former minor swing low area of 5th of Jan to 11th of Jan at 66.50. So For sure, after a 5-wave up move with a Fibo extension level and retracement level clustering around at the 6650 mark level. So with that, and the RSI, the hourly RSI also in a relatively oversold, we call it overbought, pardon me, not oversold, overbought region. There could be a chance of a minor pullback first before the Aussie dollar resume its short-term up move trajectory within its short-term uptrend phase. So with that, we will actually be flipping to a short-term bearish bias for that potential minor pullback to take shape on the Aussie dollar for today. But bear in mind, this is a very short-term technical outlook on a 1 to 2 days basis. So using 6650 as my short-term pivotal resistance level on the Australia dollar, the Aussie dollar, potentially the Aussie dollar could actually shape that minor potential pullback given the elements that I shared with you earlier on. Near-term support level to watch will be for sure at 65.80, 65.60. Okay, this former minor swing high area now turns into a pullback support, and as well clustering at the 50-day and the 200-day moving average also acting as a support level similarly to this area as well. 65.80, 65.60. Only an hourly close above 66.50 will see the continuation of this pierce up to expose the next resistance level at 67.10. Okay, this minor swing high area of 12 of Jan, which correspond to the 61.8 Fibo retracement of that previous medium-term down move. All right. So net overall, what we see over here is that the last few days of dollar weakness or dollar sell-off, potentially coming close to some sold region in terms from a dollar perspective, where we potentially today from a very short-term perspective, we could potentially see a minor dollar strength mean reversion rebound scenario taking shape. Also bear in mind with the risk event coming in later on, which is the non-farm payroll data at 9:30 p.m. Singapore time. Now, with that, let us now take a look at the major major benchmark stock indices first. All right. So let us start with the Asia Pacific stock index. Pardon me. So yesterday, right, we flipped to a short-term bearish bias for the Nikkei 225 or the Japan 225 for that pullback to take shape. Yes, the pullback actually took shape, hit the support level of 39.20. We have two support levels to watch, 39.20 and 38.850, before shipping that strong bounce up, okay, in the US session yesterday, and continue to solidify today in the Asia Pacific session, where it start to shape a higher low, and this higher low has been we call it a translate into the momentum indicator as well, okay, or the hourly RSI, higher low holding above, now back above the 50-day, the 50 level mark on the hourly RSI. So with that, right, we will be flipping back to a bullish bias, indicating to us that this minor corrective pullback more or less has ended, as long as 38,850 short-term pivotal support holds. So 38,850 will be my short-term pivotal support for today. Why this level is pretty key? Because it's confluence with the minor ascending channel that I draw from the low of 4th of Jan, the upward sloping 20-day moving average as well, and graphically the minor swing low area of 29th of February. So that is correspond close to the former all-time high in December as well at 38,957. So as long as this 38,850 short-term pivotal support holds on the Japan 225, we'll be flipping to back to a bullish bias for today. First resistance to watch for sure will be at this level, this area here, where it kickstart that former minor corrective pullback, 40,490 / 40,690. Above it exposes the next near-term resistance, a Fibo extension cluster level, one time and 1.382, 40,980. All right, also very close to the psychological level of 41K. Then we have the Hang Seng, or the Hong Kong 33, continue to be trapped sideways, continue to print lower high over here, lower high. Still no change, using 16,670 as my short-term pivotal resistance level. Still maintain that short-term bearish bias. First support level to watch will be the minor range support right now that seems to have formed at around the 50-day moving average, 16,080 level. Okay, so that will be the first support level to watch in our still maintaining that short-term bearish bias on the Hong Kong 33. Only an hourly close above 16,670 will invalidate this short-term bearish bias to see a potential squeeze up to expose the next near-term resistance zone of 16,860, 17,010 / 17,130. Okay, German 30, which is the DAX, European, one of the European major benchmark stock indices. So the DAX actually continue to remain strong, hit our resistance yesterday at 17,850 / 17,890. So this level has already been met, and with the hourly RSI now hovering at the overbought level, so there could be a chance of a minor pullback today. So pullback level to watch in terms of the near-term support level will be this, for sure, this former minor range stop of 17,750 now turns into a pullback resistance, a pullback support level, pardon me, but I do not want to use the 17,750 as my short-term pivotal support for today because it's a bit tight. I'll rather use at 17,650. Why? Because it's confluencing with more elements. The lower boundary of this minor ascending channel that I drew from the low of 14th of February, and as well as very clearly the minor swing low that has been tested 3 times so far, 5th of March, 6th of March, and as well as yesterday that V-shaped rebound. Okay, so for sure this 17,650 is a much more substantial, important support level. So that will be my short-term pivotal support level for today to maintain this short-term bullish outlook or bullish bias on the German 30. So any potential minor corrective pullback, as long as it didn't break below 17,650, we will still maintain that short-term bullish bias. Next resistance level to watch will be at 18,050, 18,100 Fibo extension cluster level, and as well as the upper limit of this minor ascending channel that I drew from the low of 14th of February. Only an hourly close below 17,650, 17,650, pardon me, will invalidate this short-term bullish outlook to see the extension of that minor corrective decline to shape a further pullback to retest the 20-day moving average. I think as the next near-term support zone of 17,450, 17,355. All right, US benchmark stock indices. The Dow Jones Industrial Average going to trade sideways. Yesterday price action retested the upper limit of the neutrality range that we have yesterday, 38,850. Then thereafter it comes break up and start to shape downwards as well. So recall that this level is important. Why? Because it confluences with two other elements. Graphically, the former minor ascending channel support from the low of 18th of Jan now turns into a pullback resistance, and as well as the 20-day moving average now turning into a pullback resistance, all at the similar zone of 38,770, 38,850. So still no change. Still have that neutrality bias on the US Wall Street 30, given its very mixed, choppy price action right now. Neutral between 38,850 and 38,360. Only an hourly close above 38,850 will validate this positive price action coming back into the US Wall Street 30. Next resistance level to watch will be at 39,100, followed by 39,400. Okay, if 38,850 is taken up, is broken up on upside. Now, the one that is surprisingly still strong will be the Nasdaq 100. So Nasdaq 100 yesterday, we attempt to actually flip to a bearish bias, anticipating another potential minor corrective decline down leg towards the 17,650 level. At this level over here, what we will do over here is perhaps the price action may not hit the 17,650 level, given it's a very strong momentum that is being seen yesterday, especially printing a higher low over here, right at the 20-day moving average that was being tested earlier on of the yesterday's session, then thereafter shaping a bounce back to retest the current all-time high area of 18,335. And if you look at the RSI over here as well, the RSI, yes, it actually went back to the overbought region yesterday, but it didn't actually shape a bearish divergence. Okay, so indicating to us that the short-term bullish momentum still remains intact on the Nasdaq 100. So we will be using the 18,950 level as my key short-term pivotal support level for today. So this is a pretty key level. Why? Because yesterday there's an intraday low, almost test this level before recovering. So this is the close of the US session before recovering right now in the Asia session. So 18,095 short-term pivotal support flipped back to a bullish bias on the Nasdaq 100. Break up above 18,035 may expose the next near-term resistance level at 18,435/18,470 Fibo extension cluster level. Only an hourly close back below the 18,095 will invalidate the bullish tone to see the revival of that minor corrective decline scenario. Support level to watch next, 17,810 for sure, followed by 17,650. All right, so overall, rather mixed bag short-term technical outlook across the board for the major major stock indices, pardon me. All right, so now moving forward, let's take a look at WTI crude oil price. All right, West Texas oil, give me a minute, let me open up the chart. Okay, so for West Texas oil, no change. The price action continue to remain above the short-term pivotal support level that we have since the start of this week at 78.40. So yesterday it managed to came down in the US session and retested again and shaped a bounce. And what's interesting over here now is start to flash two sets of higher low right at the 78.14 level that we predefined at the start of this week, and now confluence with the 20-day and the 20-day and the 200-day acting as a support at a similar level as well. So for sure, this is a very key support level to maintain this short-term bullish outlook on the West Texas oil. So as long as this level holds 78.14 level, the next intermediate resistance level to watch will be at the 81.65 level. However, an hourly close below 78.14 will invalidate this bullish bias on the West Texas oil to actually kickstart another round of choppy corrective decline scenario back into its range resistance level. Okay, back into this very choppy range resistance level that was in place previously mid of November last year. Next support level to watch will be at 76.20, 75.75, which is the 50-day moving average, acting as a support level as well at this zone, and the swing low area of 26th of February and 15th of February. So lastly, before we go with spot gold, so spot gold yesterday going to rally, didn't break down our downside trigger level that we have, and almost hit the 21.75 resistance level that we mentioned yesterday as well. So what we could see right now, interestingly, that it going to flash that bearish divergence, all right, over here. So I'll be using the 21.75 short-term pivotal resistance level, and also given that we may start to see a bit of a bit of potential minor dollar strength mean reversion rebound scenario coming back into the market in a short-term basis. Then we talk about 1 to 2 days potentially based on the technical chart of the FX major pair that I shared with you earlier on, and I highlight that potential elements that could potentially support that mean reversion, short-term mean reversion dollar rebound scenario. So with a potential mean reversion dollar rebound scenario, it could add a bit of mean reversion pullback in spot gold, given the fact that gold and the dollar has an inverse relationship traditionally. So I'll be using 21.75 as a short-term pivotal resistance level for today. Potential of mean reversion decline, minor mean reversion decline scenario within a short and medium-term uptrend phase that is still intact on spot gold. Why? Because clearly the price action has been trading above the 50 and the 20-day moving average, and right now the 20-day moving average has really surpassed the 50-day moving average as well. So near-term support level to watch for this potential mean reversion pullback scenario to play out for spot gold XAU/USD will be 2125 followed by 2110. So if you do the Fibo retracement level of this steep up move rally, okay, is around the 23% and the 38.2% Fibo retracement. Okay, however, an hourly close above 21.75 will invalidate this potential minor corrective pullback scenario to see the continuation of this impulsive up move to expose the next next intermediate resistance level at 21 figure level, 22,200, pardon me, and 22,210 resistance level. All right, so with that pretty much sum up for today's daily dose of market insight. Slightly a bit later for today. Why? Because I need to explain to you the current dynamics of the market, which is pretty interesting right now based from a intermarket perspective. Okay, so with that, I hope that I could paint a clearer picture on the current movement of the cross asset classes. So with that, do have a great day ahead, and I wish you all a good weekend, and we shall speak again on next Monday. Thank you.